Welcome to the Salty Investors episode number 36.
Yep.
It is Friday, June the 16th, 2023. How are you this fine Friday, Tim?
Yeah, a little bit chilly, but great. Yourself?
Yeah, it is a bit chilly, but clear blue skies. I'll be getting out into that later. But first, let's deal with the salt as we do every week. I've got just a general salt about the fact that the S&P 500 has now broken through 4,400. It's within 8% of all-time highs. The Fed is on pause. The Fed is forecasting lower unemployment, higher GDP growth for 2023, according to the dot plot, even with higher inflation and possibly higher Fed funds rates later in the year. So it's all blue skies, Tim. I'm sitting on a pile of cash. I didn't deploy it. I'm going to have to wait another 10 years. What do you reckon?
Yeah, I just looked at a couple this morning. Oracle was one that, I thought, oh, maybe I'll buy some of that. But I said, oh, no, I'll hold off. And now it's 40%. I think Nvidia and Microsoft are the only ones beating it. But,
Yep.
yeah, I don't know. You feel a bit like this is a long period of time. Like, obviously, we've got to reassess maybe. Maybe we have missed it a little bit here, but interest rates at 5%, mortgage rates at 6 to 9%. I thought that normally that would suck liquidity out of the system and make people make a few hard decisions and sell a few things. But this time it could be different. I don't know.
Well, it depends in history where you are, because a Fed funds at 5 is usually not particularly bad, but it in relative terms compared to where we were, liquidity being sucked out of the system, definitely. We are in a retail recession here in Australia. We'll get to that later anyway. I'll let you give us your salt for the week.
I saw that a study was put out that 66 Australians, millionaires, aren't paying any tax, and I thought, oh, that's a bit weird. How can all these people get away with tax? I like free stuff. I wish these millionaires started paying tax, but I started looking into it, and they started talking about loopholes, and I go, what loopholes? And going, oh, they must be talking about, if you make a loss one year, you can carry that over to the next year.
Oh, that's a loophole.
That's a loophole. If they close down that loophole, what would happen? Well, people wouldn't take on risky investments, and then they would, just stick with gold or put the money in the bank, and they wouldn't make any loss. So we wouldn't get anything anyway, but then we wouldn't have all these people creating businesses and taking all this risk to, create jobs.
What do they want? Do they want people to pay tax even though they didn't make any money? Is that what they want in the years? Yeah. So, I mean, as you say, imagine, you kill investment because people are like, well, I know this business is going to take 2 to 3 years to get break even. But I'm going to have to pay tax anyway because the commies are upset that, in future years, when I do start making money, I won't have to pay any tax for a couple of years.
Yep.
Because I can offset from previous years' losses. It's the same with capital gains. But see, this is the resentment class at it again, because they don't have any shares. They don't have any franking credits. They don't have any capital losses they can offset against capital gains. They don't have a business because they work some salary job where there are no deductions. They can't claim anything.
There's no risk either in a salary.
That's right. Yeah.
You don't have any risk, so you don't understand risk at all. Like,
yeah.
So, you feel like, oh yeah, maybe I should be hitting these people. But they all vote, they all get a vote here. And it's just like, and it seems to be getting worse and worse. And you're wondering what's going to happen, in a couple of years' time. Like, so they all work in government departments, I suppose. They don't have to worry about it, but I don't know.
Yeah, well, as I said during COVID, if you have an opinion about lockdowns and you think they were fine, you should declare up front whether your income was affected or not. Because you find a strong correlation between the people whose lifestyle actually improved in terms of they got to stay home a bit, still got paid. If you were in the public service and you didn't have a laptop, they bought you one so you could work from home. There are people there was an article out in The Guardian just a couple of weeks ago, I think, saying from some woman about how she missed lockdown. Right. Now only someone who has the capacity to work from home and their income wasn't affected could actually say that.
Mm.
For people who have to go to physical locations and do work and run their own businesses, it's
Mm. Yep. Yeah, they can't
risk
really.
and reward.
Yeah, they're just, thinking of themselves, I suppose. I can understand it to a degree, but
Yeah.
just if you knock away my free lunch here, I'm not going to get any free lunch, you pricks.
No. Well, I suppose that's why you have more nanny statism, because people are so used to, they want comfortable, predictable, and they get that with a salary job from the public service.
Mhm.
It's pretty hard to get fired.
Yep.
And yeah, they want more of that. They want more of daddy government to do it for them. Problem is they never check out how much the bill for that is. Yeah. All right. Well, let's move along. This week, of course, the big news this week is probably the Fed decision. So look at that nice round trip, Tim. It's taken, it's basically 2007,
Yeah.
and we're back to where we are. That's where the
Oh.
Fed funds rate is. But of course, the big news this week was that they're on hold. They paused. Now I put the dot plot in there. That headline, I've just superimposed a Bloomberg headline over the top of the dot plot,
Okay.
because it really sort of sums it up. So Powell says nearly all officials expect some further Fed hikes. So they're, usual stuff. We're going on pause to assess the incoming data. But you notice the dot plot, everyone's above 5% now for 2023, and the median is 5.6%, which suggests maybe another 50 basis points. That thing changes all the time. They also, all the out years as well, like 24, 25, they've all been elevated. So the story is, we've been saying this too, inflation higher for longer. Mm-hmm. So if you look at I haven't included these, but the inflation forecasts are higher for longer. But on the economic side, their unemployment for this year has come from 4.5% to 4.1%. And I'm just remembering this off the top of my head. And GDP, they said, was only going to grow 0.4%. It's going to be 1% for this year. So it's looking like it kind of counterintuitive if you think about it. The Fed funds rate's going to be higher for longer, but the economy is going to be better. And I just wonder whether it's sort of it's just the fact that it's just taken longer to filter through. Like as we seen in Australia, like you and I were, I was anyway last year, talking about how, look out, the retailers are going to start. They're going to start feeling some pain. They're going to be forecasting pain in the early part of the year, and it's actually taken to the middle of the year to actually get some. So, yeah, that's what the Fed is saying. So, what do you think? What do you make of this? So we're looking at higher interest rates, inflation higher for longer, but economy better. So, where is this resilience coming from, Tim? Or something doesn't add up?
Well, they printed a lot of money, and that's coming back into the picture again. M2 is still cratering, like it's cratering quick. So it's not looking good on some of these metrics. And the cut in the second half of the year, I don't see people talking about that anymore. That seems to be off the cards.
That's off the table. Remember, that was the bull case, right? They'll be cutting rates. Well, look at that. The idiot Stephen Koukoulas in Australia. He said there'd be no rate rises this year, and they'd be cutting rates by the middle of the year. And they're right. Like that's Koukoulas. So that bull case is gone, but I guess it's been replaced by soft landing.
Yes.
No, remember a few months ago they were talking about no landing. That's kind of ameliorated. One thing I haven't included this week was there was a report out saying that like we haven't talked about this for a while and sort of receded from public interest, is the mini banking crisis. There's been as many banks fail in the US through the first 6 months or more than there was in the entirety of last year. Something like 40 odd banks went out of business last year. That number's gone out of business in the first half of the year, and more of it's been packed into this last 3 months. So, yeah.
Well, if they got a couple more rate rises, that's going to make it worse. So, And then people, why would they, if you've got over 250 grand, whatever it is in the US, why would you hold it in a regional bank? Just makes
you
no
wouldn't.
sense at all.
Yeah.
So
Yeah.
you can see it's going to cause a run there, and they're not lifting their deposit rates as well because they're trying to offset them. So
Yeah.
people are running
Yeah.
for the hills here, and Jamie Dimon is like rubbing his hands together here, like he's he's just got inflows coming everywhere. Like,
Yeah.
I don't know. So interesting.
Yeah. This is from B of A. B of A have been pretty bearish for a while. So this is just initial jobless claims, which is we've discussed this before. Sometimes it's called a leading indicator of employment. It's not really. It's more like a coincident indicator, but it does lead employment, the official employment figures, which are typically lagging. And that's been inverted against the availability of loans for small business. Now that's the one that I'm not that interested in the jobless claims number. I'm more interested in the availability of loans for small business. So that's rolling over. It doesn't do that very often. Obviously, '08 it cratered, and the last time really, because remember if you look at 2000, there's a little bit of a dip, but the thing that people forget about the tech bubble is it was largely an equity bubble. All this money poured into IPOs and things, and there wasn't a debt crisis in the tech bubble. So yeah, I think that's rolling over. It's just a source of concern. So again, it plays back into that idea that liquidity crunch, at least, and you can't get strong growth with that looming. But stock market's pointing up. All a bit confusing. It's somewhat frustrating here because we've sort of been correct, if not early, about interest rates, inflation staying around
Still
longer.
hasn't gone away.
we and it actually seems to be worse than you or I even thought, but the stock market is not cooperating. But that's usually the way it goes. You never get what you want perfectly.
Yeah, it's like at the party at the end of the night. Everyone's still had a few drinks in them. It takes a while for that to wear off a little bit. I think. So I don't know.
I thought you were going to say people left at the party looking around for someone to take home and they can't find anyone. That's why I feel like at the stock market, I'm looking around, I'm thinking they're all too expensive. They're all too ugly, even with my beer goggles on. I still can't do it.
Yeah, all my falling knives don't look good at all, so I can't even add to them. So
yeah,
I don't know.
So this is the ongoing retail recession watch in Australia. This is it took this from the Australian, but basically David Jones came out, and these are a lot of their major stores, flagship stores, city stores, a couple of regional ones there Tugra's in Sydney. I don't know. Okay. Sunshine Plaza. I'm not sure. Is that Sunshine Coast or is that Sydney? I don't know.
Yeah.
But you can see there. Some of them are down 30%, 28%, 21%. An average of about I don't know, mid-teens. Total. Well, the total's down 10% because I guess some of those big stores hold up better than others. But geez, that's pretty bad. Like for like sales down 10%. You've seen some of the other smaller retailers we put in the last couple of weeks down like for likes 3 to 4%, 5 or 6, down 10%. That's a lot. This has been a shitty business through all different types of ownership and restructures and all kinds of crap, selling stuff off. It's just been a crappy business for about 20 years. It's up there with AMP as a crappy business for the last 20 years. But yeah, it's just ongoing.
So why do the regionals get hit worse compared to the flagship stores? Why is there such a big disparity there? You're looking at 10%.
Is it the fact that you have tourist traffic in the city stores that you don't have in regionals? I don't know.
Yeah, because that's a huge difference, isn't it? Like you're going from 10 to 20 to 30. That's a huge. And the further you get out, the worse it gets. So Yeah.
Yeah.
I don't know, the regionals, are they really hurting more than the inner city?
But I mean, Warringah Mall is not. I mean, that's
okay.
Manly. I mean, that's North Shore. It's not.
Inner
This is
city.
not
Yeah.
a.
Yeah.
It's not a non-affluent population over there. If you've
Mm.
been over there, I mean, yeah. I mean, Bondi Junction down 14. Nearly 14%.
Yep. Mm.
Yeah, crazy.
Yep.
Adelaide Central, where they've got the batteries and all their renewable energy, and people got such cheap electricity prices. I'm being sarcastic if you can't tell. It's down double digits, the middle of Adelaide.
Yeah.
Burke Street Mall. I mean, Christ,
And Christmas is a while off. Like, not gonna, get another bump until the end of the year, and this continues. Like, they'll be relying on Christmas to freaking pull this around a bit, So,
yeah. Well, I mean, this could be, again, like we were saying last year. Oh, look out! This year, Christmas is going to be tough. It's actually this year's. It's going to be this one, isn't it? It's going to be this one. So I'm glad I didn't buy that new computer last year, because that's this year.
I'll be giving you cash to take them away.
Yeah. Please take this. We don't have
Get it off the books. Yeah.
Yeah. Okay. Enough about the. I mean, I feel like I've been waiting so long for this. Like it's actually here, and it's like there doesn't seem to be widespread recognition that this is going on. But I mean, it's obvious now that people are pulling back, and it's obvious now that people are, following what Phil Lowe said. Well, they were already doing it. They didn't need Phil Lowe to tell them. They're already cutting back because they have to. Alrighty, stock of the week, ZTS.
Zoetis, I think it's how you pronounce it. Basically, this is a Pfizer spin-off. So Pfizer, used to be involved with animal drugs. And this is back with the Terry Smith thing. Companion animals are going to be with us, and it's going to be ever growing. The economy slows down. People probably have less kids, but they'll probably have a dog, or a cat or something for a bit of company. And, I see going forward 10 years, that's only going to increase, and it's not going anywhere. They've got a bit of a moat. Like, people don't, it's not as sexy as pharmaceuticals. That's what we hate about pharmaceuticals. They're always investing in new stuff, and trying to find the next biggest thing. Costs them, an arm and a leg. So you don't ever get anything back, because they're always reinvesting it all. And sometimes you never get a dividend or, buybacks or anything. So there's nothing there for the investor normally in pharmaceuticals, unless you pick a winner, which is, how do you know what you're doing? But with animals, the drugs have actually got a bit more legs to them. Like, there's not as many people competing against in that area. They've still got the patents and the trademarks and all that. And, you've got all the regulatory control as well to stop people coming in the market and undercutting you. So you got those. So you look at the shares outstanding, it's all going in the right direction. Return on invested capital, it's not anything to write home to mum about, but, like, it's in the high teens here. You look at your one, return on equity, you'll be...
Not good margins, gross. Operating margins.
Look at that operating margin, in the 30s. Like, you're definitely setting it home. But you look at the price of it, it's a little bit pricey, price to free cash flow in the 30s. It does get down in the 20s. So if you looked in 17, 16, 17, you could have picked this up in the 20s, which would have been, a pretty good buy. You look at the dividend, you got a little dividend, 30% payout ratio is nothing crazy. Interest coverage is 10, but fly over to the balance. And you can see the short-term debt here. We've got a few long-term liabilities actually coming up in the next 12 months. You've got 1.3 billion something. So that's pretty concerning. But these guys can, issue debt. Like, there's no problem. They've got a total of 4.5 billion here in net debt. A lot of that's long-term. It's got that 1.3 coming up. They got about that in cash flow if you fly over to the next sheet.
Cash. Yeah. Okay. So they're doing about $2 billion a year in cash flow.
Yeah.
Operating. Free cash flow is about 1.3. Okay. Yeah.
So you can see here back in 17, 18 was the time when, price operating cash flow, that's when you should have been, it doesn't get cheap. Like these things just don't get cheap.
No.
These are the things that you just buy and put away and forget about them, really. So it's one of those things, you look at 10 years, not going to have to worry about it. You're not going to look them up and go, oh, which drug they've got coming up the line, pipeline, and, which one's going out. They're always working on it and reinvesting pretty well. It's the next Pfizer. So if you understand.
We might close it down. Thanks to Tim for bringing Zoetis, another play on the companion animal segment. We will see you next week.